What are you actually buying when you purchase a stock? A number on a screen, a lottery ticket, or a real piece of a business? In this video, we'll break down exactly what a stock is, how companies use stocks to raise money, why stock prices move, and what investors truly own when they invest. By the end, you'll understand stocks better than most beginner investors.
Your path to financial freedom starts here. Subscribe for exclusive investing tips. Wealth mode activated.
A stock represents partial ownership in a company. When you buy one share of stock, you own a small piece of that business. If a company has 1 million shares and you own 1,000 shares, you own 0.1% of the company. That means you are not just betting on the company. Legally, you are one of the owners. Even if you only own a tiny fraction, your investment rises or falls based on the company's success. Companies sell stocks because they need money to grow. One way to raise money is borrowing from banks. Another way is selling ownership through stocks. When a company first offers shares to the public, it's called an IPO, an initial public offering. When you buy shares, you gain certain rights as a shareholder. You may receive voting rights, meaning you can vote on important company decisions. Some companies also pay dividends, a portion of profits shared with investors. But most investors buy stocks because they hope the company becomes more valuable over time. Stock prices move because investors constantly buy and sell shares. If more people want to buy than sell, prices usually go up. If more people want to sell, prices usually fall. Investor expectations drive the market. People are buying future potential, not just today's profits. Imagine buying a small local coffee shop with your friends. If the shop grows, earns more money, and opens new locations, your ownership becomes more valuable. That's essentially how stocks work, just on a much larger scale. Many beginners think stocks are random gambling. But real investing is about understanding businesses, revenue, profits, and long-term growth. Another mistake is obsessing over daily price movements. Professional investors often focus on years, not days. There are two main ways investors make money from stocks. First, capital gains. That means your shares become worth more than what you originally paid. Second, dividends. Some companies regularly share profits with shareholders. Stocks can build wealth, but they also carry risk. Companies can fail, economies can slow down, markets can crash. Short-term prices are unpredictable, which is why investing requires patience. Instead of buying individual stocks, many beginners choose index funds. An index fund owns small pieces of many companies at once. This reduces the risk of relying on a single company. At its core, investing in stocks means investing in human progress. You are backing companies that create products, solve problems, and generate economic value.